Welcome to the Deep Dive, where we cut through the noise of earnings calls and deliver the crucial insights directly to you.
Hey there.
Today, we're taking an in-depth look at Easterly Government Properties Q2 2025 earnings call that happened back on August 5th.
Yeah, and our mission here is really to unravel their recent financial performance, take a close look at their strategic moves,
Right.
and figure out what management's outlook and their capital plans actually mean for this pretty essential government real estate player.
That's right, because Easterly, they've made some very deliberate, maybe even bold choices recently.
Definitely.
So the big question we're tackling today is, are these tough decisions starting to pay off? And how is management sort of strategically positioning the company now to leverage these changes, especially, in what's still a pretty tricky real estate market?
Exactly. So let's kick things off with the headline numbers for Q2 2025. Easterly Government Properties reported a GAAP EPS of 0.09 cents. That's on a diluted basis. But, for REIT followers, maybe more telling is their non-GAAP Core FFO per share. That came in at $1.74.
Okay, and just a quick reminder for everyone, GAAP EPS is that standard earnings per share number. But for a REIT like Easterly, FFO, funds from operations, is often seen as maybe a better gauge of profitability.
Yeah, absolutely.
It strips out things like depreciation, non-cash stuff, giving you a clearer look at the actual cash the properties are generating.
Precisely.
And that $1.74 FFO per share, you said that's up year over year.
It is a healthy 3% increase compared to last year.
Okay. And the top line, revenue.
Revenue hit $84.2 million.
Yeah.
Now, this is a robust 10.5% jump from the prior year.
Wow.
And it comfortably beat the consensus estimates, which were sitting around $81.8 million.
Right
So
on.
a solid beat on both revenue and FFO. Always good to see.
Definitely. So how did the market take it? What was the reaction?
Well, the initial reaction was measured, I'd say, but leaning positive.
Okay.
Shares saw a modest uptick on the call day, closing up about 1.4%.
So nothing crazy.
Now, not an electrifying surge, but it signaled a stable reception. It suggests investors basically found the results, in line or maybe just a touch better than they expected. No major shocks.
Right. No big disappointments either. Okay, so those headline numbers, they give us a decent starting point. But like we hinted, the real story is often, a bit deeper. It's in the management commentary, the strategy.
Exactly. And what's really fascinating here is how these Q2 results aren't just standalone numbers. They actually directly reflect some big corporate actions they took earlier, designed to sort of reset their path.
Ah, right. You mean the dividend change?
Yeah, back in April, Easterly made that difficult call, so they framed it as necessary to cut the dividend and reset their whole payout framework.
Mm-hmm.
Management really emphasized this was crucial to preserve flexibility and position the company for sustainable growth down the road.
Yeah, a dividend cut's never easy for investors. But if you kind of peel back what management's saying, it really signals they're very aware of the current capital market, right?
Absolutely.
It looks like a clear pivot towards maybe self-funding their growth in this higher rate environment instead of just relying on external money or paying out cash they could reinvest.
Right. It's not just preserving flexibility, like you said. It feels like a strategic move to buffer themselves against future rate swings and build value internally.
Makes sense. And that wasn't the only big thing they did back then, was it?
No. Also in April, they did that 1 for 2.5 reverse stock split.
Right. Explain that quickly.
Basically, for every 2.5 shares you held, you now own 1.
Right.
So each remaining share becomes proportionally more valuable, at least on paper initially.
So why do that? What's the point?
Well, the stated aim was to enhance capital structure flexibility, obviously boost the per share price, and maybe improve index alignment, make it more appealing to certain institutional investors who might have rules against holding lower price stocks. It seems like part of a wider plan to kind of rebuild their shareholder base with more long-term folks.
Okay, so let's dive into the actual operations for the quarter. Core FFO was what, $34.6 million?
That's right, $34.6 million. And cash available for distribution, or CAD, was $29.3 million.
In CAD, just quickly, that's FFO minus necessary capital spending, right? So it's a clear picture of cash truly available to maybe pay dividends or reinvest.
Exactly. That's the cash left over. And these figures, the FFO and CAD, they really provide the backdrop for management's constant talk about disciplined growth and smart capital allocation.
Right. The CEO, Daryl Crate, when he spoke, he really hammered home the resilience of their portfolio, didn't he?
He did. He specifically emphasized that focus on mission-critical infrastructure. courthouses, law enforcement labs, public health clinics, secured facilities.
Yeah, stuff the government really needs to function.
Right. Described as indispensable and crucially underpinned by those long-term, non-cancelable leases. That's a huge plus in today's commercial real estate world, wouldn't you say?
Oh, absolutely. That's their defensive moat, really. But okay, even with long leases, expirations are always a thing. How are they managing that? That can be a weak spot for any REIT.
That's a fair point. The CFO, Allison Marino, she detailed pretty significant progress they've made on renewals for both 2025 and 2026.
Okay.
And what's interesting is their soft-term lease exposure leases nearing their end actually went down. It was 5.2% at year end. Now it's 4.7% at the end of Q2.
So they're getting ahead of it.
Seems like it. It points to strong proactive work with the federal agencies, figuring out their needs.
And they gave that example, right? The Forest Service renewal in Albuquerque.
Yeah, that was a great example. A finalized 5-year firm-term renewal. And what's really telling there is that it includes built-in annual rent escalators.
Ah, okay. So not just locking it in, but locking in growth too.
Exactly. It's not just a simple renewal. It might signal a bit of modernization in how the government is thinking about real estate, maybe valuing quality more explicitly, and it definitely gives Easterly some built-in inflation protection.
Makes sense. Now, what about growth? How are they approaching adding new properties?
Well, management really underscored a strategy of, quote, disciplined external growth.
Discipline, okay.
Meaning they're targeting opportunities that offer a 150 basis point spread to their cost of capital.
Okay, break that down. 150 basis points is 1.5%.
Right.
So they want deals that yield 1.5% more than what it costs them to fund the deal, whether that's through debt or equity.
Precisely. It seems like a sensible hurdle, especially as they mentioned their current cost of capital is somewhere in the 8s.
So aiming for deals yielding in the 9s, effectively?
Yeah, this disciplined approach allows for accretive deals that actually add to their FFO per share. So yeah, effectively developing or acquiring in the 9s on a cap rate basis.
And a cap rate, just for clarity, is like the property's annual income divided by its price, a measure of return. Higher means potentially higher return or maybe higher risk. Aiming for 9 sounds pretty attractive.
It does suggest they're finding decent value-add projects.
And have they actually been doing deals? Or is this just theoretical?
They've been active. They completed some key acquisitions, Capitol Plaza in DC, that's a big government-leased building, and a facility anchored by DHS, Department of Homeland Security, in Burlington.
Oh, yeah.
Plus, they secured land for a brand new federal courthouse development out in Medford, Oregon. They're planning to invest somewhere between $25 million and $75 million on that development during 2025.
So that's real tangible growth, not just sitting on existing stuff.
Yeah, active growth.
What about the balance sheet? How's their financial health looking?
It looks pretty solid. They report $122 million available on their revolver. That's their credit line, basically ready cash.
Okay.
And they expect another $115 million in liquidity later this year from a lump sum repayment related to an FDA property in Atlanta.
So decent liquidity and leverage, debt levels.
The leverage ratio is sitting comfortably within their target range, which is 6.5 to 7.5 times net debt to EBITDA.
Okay.
Now, the cost of capital, as we mentioned, it's still a bit elevated, probably because of that recent dividend reset kind of weighing on the stock.
Sure, that takes time to wash through.
Exactly. But their focus remains firmly on being selective, prioritizing quality, and staying disciplined when they deploy capital.
Okay, so given that discipline, that selectivity, what does this all mean for the rest of the year? What's the outlook they provided?
Well, importantly, they maintain their full year 2025 guidance for Core FFO per share. It's still in the range of $2.98 to $3.03.
Okay.
Which reflects that projected 2% to 3% year-over-year growth we talked about. So a consistent path forward, basically.
No change there. And the acquisition pipeline?
They mentioned a pretty substantial pipeline, actually. $1 billion to $1.5 billion worth of potential deals.
Oh.
But, and this is key, they immediately stressed again their selective approach. They're only going after the best opportunities. It really sounds like quality over quantity, especially, when capital isn't cheap.
Right. Makes sense. So if we zoom out a bit, connect this to the bigger picture, how does Easterly stack up in the broader REIT world right now?
Well, their performance continues to position them as a pretty defensive play within the REIT sector. What's quite striking, actually, is that over the past month, and even the past year, their trailing total return has actually outperformed the broader REIT market. if you benchmark it against something like the VNQ ETF.
Huh, that's interesting. Especially when you think listed REITs are really just starting to stabilize and everyone's kind of hoping for rate cuts eventually.
Exactly.
Their specific focus, that laser focus on government tenants, it really does seem to make them comparatively defensive against some of the big headwinds hitting, say, general office space.
For sure.
But I wonder, could that same laser focus on just one type of tenant, even if it's stable Uncle Sam, also limit their growth potential maybe? Or expose them if there were, I don't know, some big shift in government real estate policy?
That's a fair question.
Yeah.
And yeah, niche focus always carries some specific risks. But I think the argument is the sheer stability and the, top tier credit quality of the federal government largely offsets that.
Right.
Those non-cancelable long-term leases on mission-critical buildings,
Yeah.
it's a powerful buffer. The challenge for Easterly probably isn't finding tenants. It's finding the right deals, the accretive acquisitions and developments that hit those strict return goals we talked about.
Yeah, that makes sense. And that 10.5% year-over-year revenue growth we saw, that definitely supports the idea that there's fundamental strength within their niche.
Absolutely.
Yeah.
So I think the overall sentiment around the company right now feels cautiously bullish. You see clear execution, the guidance is holding steady, and having that visible pipeline helps offset some of those macro concerns and capital cost headwinds that maybe other REITs are feeling more sharply. It's a steady ship kind of story.
A reliable story in a sometimes choppy sector. Okay, so looking ahead, what are the key things we should be watching for? What are the potential catalysts?
Several things, I think. Definitely keep an eye on the ongoing quarterly leasing and renewal updates. That's core to their business model, so execution there is key.
Right.
Also, the successful closing and then stabilization of those recent acquisitions like the DC and DHS properties, getting those fully integrated and performing as expected.
Makes sense. And what about that new courthouse project?
Yeah, I'm curious about that too. Seeing progress milestones on the Medford courthouse development will be important. It's a big project, and it could really showcase their ability to create value through new builds, not just buying existing stuff. And then, of course, broader market factors. Any shifts in interest rates, positive or negative, could definitely impact REIT valuations across the board. That could be a tailwind if rates ease.
True.
The next really big checkpoint will be when they give their Q3 results and likely revisit that full-year outlook again.
All right, this brings us to the part of the show where we absolutely have to stress this is not financial advice.
Okay. Definitely not.
We're about to toss out a couple of, let's call them outrageous but plausible trade ideas, purely for your consideration, for your own research. Think of it as a mental workout, not a recommendation.
Okay. First idea.
Yeah.
Consider a straight long position in Easterly government properties. Maybe pair it with a longer dated call option, thinking, say, 12 to 18 months out.
Okay, the thesis.
This is basically a safe harbor play. You're betting on that inherent stability of government tenancy, combined with the possibility of interest rates gradually normalizing over that time frame. If capital costs do ease up and the market starts rewarding quality and predictability again, that dividend reset overhang we talked about could fade. That could lead to yield compression.
Meaning the share price goes up relative to the dividend.
Right. And general share appreciation. The call option just gives you some leveraged upside if they really execute well on rebuilding that shareholder base and hitting their growth targets. It magnifies the potential gain if that re-rating happens.
Right, interesting. Got another one.
Yep, here's another one to chew on. A pair trade.
Okay.
Go long Easterly, but at the same time short a diversified basket of general office REITs, especially ones with heavy exposure to, cyclical private sector tenants.
Betting on the spread between them.
Exactly. This strategy leads right into Easterly's disciplined approach, targeting that 150 basis point spread on new projects and their relentless focus on those mission-critical, high-credit government tenants.
So you're betting that the defensive nature of federal leases will just keep outperforming the ongoing, maybe secular challenges facing the broader, less specialized office market?
Pretty much. It's a conviction play. A bet on the indispensable nature of Easterly's assets versus the more vulnerable segments of commercial real estate.
Got it. Two interesting ideas there. Definitely food for thought. Okay, so let's wrap this up. That was a deep dive into Easterly Government Properties Q2 2025 earnings call.
Yeah, we saw solid financial results, guidance holding steady.
Right. And a really clear strategic focus on those resilient, mission-critical government properties.
Management keeps hitting those notes. Disciplined growth, proactive capital management, strong execution on renewals and acquisitions. It all really supports that narrative they're pushing. Defensive yield plus steady core FFO growth, which, is a pretty appealing combination in today's market.
Absolute. Now, remember, everyone, those trade ideas we kicked around are purely for discussion, absolutely not investment recommendations. Please do your own thorough research. So what did you find most compelling or maybe surprising from this look at Easterly? We always love hearing your insights, and maybe something to ponder as you do your own research. Considering Easterly's deep focus on government stability in such a volatile market, could Uncle Sam truly become the ultimate safe haven in commercial real estate? Or are there maybe hidden risks lurking even within the most secure-seeming leases?
Good question to think about.
Definitely something to mull over. Until next time, thanks for tuning into The Deep Dive.